German Development Corporation, the World Bank and the Association of African Central Banks have commissioned Professor Thorsten Beck from CAS to produce this, making cross-border banking work for Africa. Professor Beck is with me now. Thorsten, your essential conclusion, bigger is better, but with some important caveats.
Yes, indeed. So what we've been seeing across Africa is a process of financial deepening over the past 10 years. So Africa, the financial systems of Africa, like other parts of the economy, have been, one can say, basket cases over many decades. But the last 10 years have really seen a turnaround with financial systems growing, with financial innovation helping more households, more enterprises gaining access to credit and to other financial services. And a large part of this financial deepening process have been cross-border banks. Now, when we talk about cross-border banks in Africa, traditionally we've been talking about European banks. Going back to colonial history, we've seen the British banks, Standard Chartered, Barclays, in the former British colonies. We've seen BNP Paribas, Société Générale in the French colonies. We've seen some Portuguese banks in former Portuguese colonies, and so on. What we've seen over the past 5 to 10 years is a rise of Pan-African banks, banks that have their headquarters in South Africa, in Nigeria, Morocco, and in Kenya, in Togo, and which have spread out for different reasons across the continent. Provides both new opportunities for the banks themselves, for the local economies, but also new challenges for local supervisors, for African supervisors across the continent.
Africa, though, is a hugely diverse continent with many, many countries that don't entirely get on. Surely some sort of overarching supervision or regulation is going to be almost impossible.
Well, Alex, you're right. I mean, indeed, there's a huge diversity of financial systems, financial structures across the continent. So I think a top-down approach certainly won't work. And if you look back in history, the attempts, for example, to create a common African currency have gone nowhere. What we've been observing over the past 5 to 10 years is more a bottom-up approach, where cooperation between regulators takes place more on a bilateral or a sub-regional level. So, for example, we've seen close cooperation and increasing integration of regulatory supervisory processes in the East African community between Kenya, Uganda, Tanzania, Rwanda, and now also Burundi. Why? Because there is a close financial integration. There are Kenyan banks across East Africa. There's increasing trade integration between these countries, and there's increasing realization among policymakers in the sub-region that a larger scale of these economies can bring benefit to all 5 participating economies. So it's kind of driven by the realization of joint interest and also of the opportunities that closer economic and financial integration brings. So I think it's really on the taking into account the idiosyncratic nature of different countries, of different sub-regions, that will drive this process, both of financial integration, but also on the consequent regulatory cooperation.
You speak of this bottom-up approach of African banks really succeeding here in growing cross-border. Why is it that they are beating the more established names elsewhere in the world, the ones you see in New York, in London, on every high street and in every financial centre?
Well, they used to be very prominent, obviously. I mean, you do have still Standard Chartered, Barclays, BNP Paribas, Société Générale very strong in many of these countries. You also have Citibank entering. But what you've seen is a relative stronger growth of Pan-African players. And there are different reasons for that. Partly is additional opportunities outside the home market. So, for example, South African banks started to expand across the continent after the end of apartheid. Nigerian banks started to expand after the mid-2000s when a capital increase forced them to have much more liquidity in their balance sheets. So on the one hand, it's just having more resources, having more opportunities, but also the traditional incentive for cross-border banking is follow the client. So there is increasing economic integration across the continent, and that also gives the incentive for African banks to basically expand where their clients expand into.
And your book is available online on the CAS website for download. Professor Beck, thank you very much.
Thank you.